Have you ever wondered where banks get all their money? It seems like an endless supply, flowing out for mortgages, car loans, and business ventures. The common idea is that a bank is like a giant piggy bank, storing everyone's cash in a vault and lending it out piece by piece. But the reality is far more dynamic and, in a way, more magical than that. The truth is, big banks don't really run out of money because, in a sense, they create it. When you get approved for a loan, a banker doesn't walk into a vault and count out the cash for you. Instead, the bank creates new money with a few simple keystrokes. This new money appears as a digital entry in your account, which you can then spend. The bank essentially creates a new asset, your loan, and a new liability, the deposit in your account, at the same time. This process is the core of how money is generated in our modern economy. Not by printing presses, but by commercial banks making loans. This system is built on a concept called fractional reserve banking. Imagine you deposit $1,000. The bank is required to keep a fraction of that, say 10% or $100 as a reserve. It can then lend out the remaining $900. The person who borrows that $900 will likely spend it, and the recipient will deposit it into their own bank. That second bank then keeps 10%, $90, and lends out the other $10. This cycle continues, with each loan creating a new deposit that can be lent out again. This is the money multiplier effect, where an initial deposit can lead to a much larger increase in the total money supply. Of course, this creative power isn't without limits. Banks are not free to create money endlessly. They operate under strict regulations set by financial authorities. A key rule is the capital requirement, which mandates that banks must fund a portion of their lending with their own money, not just customer deposits. This acts as a crucial buffer against potential losses. Furthermore, liquidity rules ensure banks have enough cash or easily sellable assets on hand to meet customer withdrawal demands, preventing the kind of bank runs seen in old movies. The entire system is overseen by a central bank, like the Federal Reserve in the United States. The central bank acts as the ultimate stabilizer, influencing interest rates to either encourage or discourage lending, thereby managing the overall pace of money creation. It also serves as a lender of last resort to ensure stability. Ultimately, the amount of money created also depends on us, the borrowers. If no one wants to take out loans, no new money is created. So while banks have the power to create money, this ability is balanced by regulation, central bank policy, and the simple laws of supply and demand.